So what is an EIS? Well, they were introduced by the UK government in 1994 to help encourage people to invest in smaller companies. The government wanted to help companies too small to be listed on the London Stock Exchange grow and make a bigger contribution to the UK economy. But investments in smaller companies are high risk, which means they're not suitable for everyone. To account for the additional risk associated with investment in smaller companies, the government included a number of valuable tax benefits. As the EIS market has grown, different types of EIS have been created to suit the changing needs of investors. You can use an EIS to invest in just one company, or if you'd prefer to spread the risk, you can invest in an enterprise investment scheme that receives money from each investor to assemble a portfolio of different EIS qualifying companies. So how does an EIS differ from collective investment schemes? Well, the key difference is that EIS investors own shares in the companies rather than shares or units in the EIS itself. What type of companies qualify for an EIS? The government wants EIS money to only go into smaller companies that need investment support. So, to make sure the right companies receive EIS funds, HMRC has put several restrictions in place. In order for companies to qualify for EIS investment, two important examples of what they should have are no more than £15 million in gross assets, or any investment of EIS funds should not exceed more than £5 million in any one company in any 1 year. The government also wanted to exclude certain types of companies from EIS, especially those that are property-related, such as farming or land dealing, as well as financial services companies. These types of companies were doing all right as they were. So, what kinds of tax reliefs did the government make available through an EIS? First, there's income tax relief. Your clients can get up to 30% income tax relief on up to £1 million invested each year, so long as the tax relief claimed doesn't exceed the total income tax liability for that year. So if your client invests £50,000 in an EIS, they'll be able to claim £15,000 back from the taxman. However, they must hold their investment in EIS qualifying companies for at least 3 years in order to retain their income tax relief. Second, capital gains tax deferral. If your clients have made a profit on previous investments or property, they could face a capital gains tax charge when they sell these assets. But if they invest the gains in an EIS, they can defer the capital gains tax due for the life of their EIS investment. Their capital gains tax liability is also eliminated if the investment is held at death. Third, inheritance tax relief. Money invested in EIS qualifying companies should become exempt from inheritance tax after 2 years, so long as the investments are still held at the time of death. Fourth, tax-free growth. If the investment gains in value, your client won't have to pay any capital gains tax when the time comes to sell their EIS shares, provided income tax relief has been given on the full amount invested and not withdrawn. And finally, here's the really interesting bit. If some of your holdings in an EIS investment make a loss, you can apply to HMRC for loss relief. At the current rates of income tax, up to 45% loss relief is available on any holdings that are realised at a loss, net of any income tax relief claimed on that investment. Of course, everyone's tax status is different, so how much value these tax reliefs are worth will depend on each client's individual situation. It's also important to stress that the tax reliefs depend on the companies in the EIS maintaining their EIS qualifying status. EIS investments are high risk and may not be for everyone, so you should explain the risks carefully to your client. Like with any investment, the value of shares can go down as well as up, so your clients may not get back as much as they invest. In the short term, smaller company shares tend to fluctuate a lot more in value than the shares of bigger companies, and this can concern clients with less tolerance for risk. Shares in unquoted companies can also be more difficult to sell and have higher liquidity risk than other shares. The EIS rules also require a 3-year minimum holding period. If your client sells their EIS shares before this minimum holding period, they'll have to repay any income tax relief already claimed. And finally, HMRC may change the rules on EIS tax relief in the future. there is no guarantee that companies will achieve EIS qualifying status or remain EIS qualifying in the future, or that EIS tax reliefs will remain available to investors. So an EIS may not be right for all your clients, but they offer some beneficial characteristics that may make them useful to help some of your clients meet their investment goals.